Hello, my name is Vladimir Tikhomirov. I'm chief economist at BCS Global Markets, and I'll give you my look in the macro area for the last days of 2020. There were some quite important developments that took place over the past few days that, in my view, would outline the performance of Russian market and Russian FX market in the last days of 2020. One, of course, is geopolitical risk. We have seen more accusations of Russian hackers breaking into US government networks over the past few days, although there was no formal official response from the Trump administration, and Trump himself called not to blame Russia as yet because there is not much proof, and he said that China might be also responsible. We do hear voices from the Congress and from Biden team that say that Russia very possibly was involved in these hacker attacks, and that underlines the need to be more tough with Russia. So basically, that means that the risk of new sanctions against Russia is increasing and increasing quite rapidly, and that's something that the market, local market, and the ruble would react to. The second negative factor is, of course, the COVID-19 situation. We have seen the breakout of a new virus or new modification of coronavirus in Europe, in UK. We have seen a whole range of lockdowns, which means that in the midterm, the prospects for recovering global economy are becoming more dim, which is not very good news for all markets, but particularly for risky markets and risky assets like Russian. And the third piece of news that's also on the negative side is actually the decision of the Russian Central Bank taken last week. The decision itself was quite expected, i.e. that the central bank decided to leave its rate unchanged at 4.25. But the tone of the comment and the tone of the statement made by the central bank chief during her press conference on Friday was apparently more hawkish than many expected. Basically, that means that chances for another rate cut, at least in the midterm, in the next few months, are not there. I don't think that the central bank is going to hike rates, but much would depend where inflation stands in the next couple of months. But definitely, the possibility of another rate cut is not there, and that's something that could actually trigger a shift from capital inflows to the Russian domestic bond market to capital outflows, particularly from those investors and short-term investors that were making a stake on central bank cutting the rate, and the prices of OFZ bonds going up as a result. That's not going to happen, at least not in the next few months, and that's something that could trigger a change of mood on the bond market. I might remind here that these outflows from the Russian OFZ market were the largest driver behind ruble weakness in the third quarter this year. All in all, that means that the market, and particularly Russian ruble, are going to come under increased pressure over the next few trading sessions, which makes me believe that the ruble is going to move away from the band that that it was trading in over the past couple of weeks. That's 72 to 74 rubles to the dollar, down to 75, 77 rubles to the dollar, which basically is in line with my expectation for the year-end FX rate. On the positive side, another news that came out last week was the monthly macro report from Rosstat, which has shown that apart from the consumer segment of the economy, retail sales and public services, which were down month on month and year on year compared to October. The rest of the economy has actually shown quite robust dynamic, either in line or even better than we saw in October, which was a positive surprise, basically, which means that the slide in Russian GDP in the fourth quarter could be much smaller than forecasted by the consensus and myself. I was actually expecting about 5% drop year on year in the fourth quarter in GDP. Now it looks like that the GDP slide could be on par or slightly lower, bigger than in the third quarter when the GDP fell by 3.6% year on year. So, which means that the outlook for the year, my forecast is minus 3.8% in GDP growth. Could be actually better, somewhere around minus 3.6, which is a positive surprise for the consensus and for the market. All in all, I would say that the next few weeks would be, or the next few days would be quite pressing for the Russian market and the ruble. Another factor to take into account is that Russia faces 10 days of holidays up until 11th of January. And the activity will be low, which means that many investors would be positioning themselves for this long holiday break with Western Christmas this week, which means that in the next few trading sessions, chances are that many would like to hedge the risks by increasing their positions in dollar assets and US dollar and euro versus the ruble. So ruble is likely to come under quite significant pressure. That's all I say. Thank you.